Hey IMP option traders, I want to walk you through a monthly income strategy that I do at least once a month, if not more, and they're called the Skewed Strangles. Skewed Strangles work well in neutral to uptrending markets. What does that mean? When the market's like in the middle here, trading a bit range bound, or when it's slowly going up, that is when this strategy performs best. You can use it anytime you want, but that is the ideal market conditions for the strategy. And what in the world is a Skewed Strangle? Well, a Skewed Strangle is where we cover both sides of the market. We just covered selling puts, which is where we pick a level we think that the stock won't go below. So it's something like this. As long as the stock stays above this level, we make money. Well, a Skewed Strangle is where we do this, where we sell a put, and at the same time we sell a call, where we pick a level we think the stock won't go above. So something like this. So now, as long as the market stays above this level, but also below this level, then we make money. So that's why we want the market to be a bit more neutral, or if it is uptrending, slowly uptrending. So that is how we trade Strangles. Again, this works well because it requires no more buying power than that of selling puts. When you sell a put, the only the buying power you have is the same buying power if you sell a call. Why in the world is it like that? Well, because brokers are smart enough to know that only one of your options can lose money, right? It either goes up and you break the call to the upside, or it goes down and you break the put to the downside. You can't lose on both options. So it only requires one amount of buying power, that being the highest level. Typically, the put requires the most buying power. So that's why it's more advantageous to sell Strangles sometimes than selling puts. Selling puts is a great strategy. I do it, but selling Strangles has the opportunity for you to make more money on the same amount of buying power. Now, the only issue is your win rate drops because now you have to stay below a certain level. As we know, the market likes trending up, and so by default, we're going to hit that call side sometimes. So this is how I structure this trade. I do roughly 90 days out because this gives me the ability to collect the most money, but also avoid gamma risk, but also still have some decent theta. So 90 DTE is my sweet spot. Next, I do a 10 delta put, just like when I'm selling puts. So a 10 delta put. I also do a 5 delta call. Why is the delta call further away? Well, because as we know, the market likes to trend up. So I want to put my call further away so that I can adjust for the market wanting to trend higher and I don't always hit it. If I had a 10 delta call, it would get hit way more than the 5 delta call. So this is how I structure the Strangle. I want to stay above the 10 delta put, but also below the 5 delta call. Same exact profit and loss. I have a 25% profit target, which means that if I collect $1,000 on this trade, once I hit a $250 profit, I close the trade. And like selling puts, I have a 400% stop loss, which means that if I collect $1,000, once the trade's at $4,000, meaning that I have a $3,000 loss, I will exit the trade early. This trade will have roughly a 90% win rate plus, and I'm collecting more credit than I would by selling a put. This is an amazing strategy, and let me show you the back test. I don't want you to just take my word for it. Here's the Delta Pro. Let me make my face smaller. Here is the back test exactly as I explained it. We have a 10 delta put, a 5 delta call. We're going further up to give ourselves more room to the upside. We're doing a 90 days until expiration. We have a 25% take profit and a 400% stop loss. You can see here we have a $1,100 return. Now, as we know already, this is higher than what it was when we were selling puts. Why? Because we collect more money when we do these trades. Not only that, our win rates are roughly about the same, a 98% win rate, so that's great. And we're collecting a bit more, so that's awesome as well. And we also have 15 days until expiration, which means that we make this $250 profit, or roughly $440 profit, in about 2 weeks of holding this trade. This is a 2-week hold that on average we will make $400. So it's a great trade. But as always, we need to ask yourself, where does this fail? You can see here, compared to the selling put strategy, it was outperforming the market. This one is currently underperforming the market, but it's because of some major crash periods, like right here in 2018, right here at the top of the end of 2018, and the COVID 2020 crash. All these levels, it failed and failed miserably. So how can we prevent that? Well, like we did in selling puts, we're going to be using this trending band, which will unlock in the next course of the community site. And what this does is the trending band shows you when a crash is likely to happen. When we get near this top blue line, a pullback is likely. So what does that mean? It means that we want to stay out of strangles because it's likely that our puts will get broken. The same thing to the downside. When the market is near this bottom blue line or hitting this bottom blue line, we should stay out of strangles as well. Why? Because it's likely that the market will bounce, and when it bounces, it recovers quickly. Look at this shooting up. It will break our call side if that happens. So where is the ideal environment to sell these strangles? The ideal environment is inside this blue band, not touching the blue, but inside this blue band. This is where you'll have the highest success with selling strangles, and at the same time avoid this crash, and this crash, as long as you are trading within the band. So we can take a look at the 2018 period to give you an example. So during 2018, you can see here, your call side would have been broken here because of how high it went up, and then your put side would have been broken here, leading to 2 losses. But instead, if you would have stopped trading it when it got outside of this range, you would have avoided most of these losses. So that's one of the good things there. Now, this one is a situation where you could not have avoided the loss. Thankfully, it wasn't huge. If we can come back here, you can see this was the pullback here in this area. It wasn't as big as this one or 2020. So again, this is a loss that you couldn't have avoided because you can't avoid all losses. But still, if we look at 2020, we would have stopped trading it and got out of positions when it broke above here. So we would have avoided this whole market crash and been able to make a lot of money. So if we would have avoided this crash and avoided this crash, then our profit chart would have been way above the market and we would be making a very positive return. Now again, if we're looking at this over a 10-year period, it has 139% return over 10 years. That's roughly a 14% return a year. So you're still doubling the average market return by trading this one strategy. Now, what is risk management? Because not only do we look at stop losses and take profits for risk management, but we also look at sizing. The same way we size with puts, we want no more than 10% of our account to be in any one trade. So if we're going to have a $4,000 loss is our max loss case scenario when trading ES, then we should have a $40,000 account when trading. So selling puts does require a larger account, but if you don't have that yet because you're still building, you're still adding money to it, go to MES. It's going to require a 10th of the price. So it will have a $400 max loss. So that means you'll need a $4,000 account. So that is how you sell the strangles. Now, how do you automate this strategy for people who are at work, who want to spend time with their kids, who want to focus on things that matter, not be stuck to the screen after a long day of work? Or you're really just like, I want to make sure that the stop losses are automated for me. Because believe it or not, almost all brokers cannot do stop losses on strangles because it's a call and a put and they don't know how to handle it. So that's why I built this auto trader to do it for you and handle the stop loss. We're going to go in here to create a new auto trader. We're going to enter our Tastytrade details. After successfully connecting our account, we're going to do selling strangles as our strategy. From here, we're going to do exactly as I set it up. Again, you can set it up however you would like, but I do a 10 delta put and a 5 delta call. We're selling both of these. That's how Strangle is structured. We're going to go to ES because I have a larger account size. We're going to go to Trade Weekly, 1 a week. And then we're going to go to expiration 90 days. That's what I like to target. Again, you can play with these numbers as you want. Our take profit percentage is going to be 25%, and our stop loss is going to be 400%. Now it's going to monitor that for us. And as always, what I love setting is not only the buying power for this strategy, but also making sure that it avoids market crashes. This will keep me out of both the upside and the downside risk of trading strangles. I enable safeguards, and now this strategy is available. So now I have this auto trader available to that sells strangles every single week based on our trading strategy: a 10 delta put, a 5 delta call, 400% stop loss, and 25% profit. So that is how you set up an automation that will automatically do this trade for you. It will enter it, exit, manage stop loss, and avoid crashes for you all in one place. So again, this is the beta version of our auto trader that's going to be releasing very soon, but I hope you're able to use and enjoy this strategy yourself in the meantime.